Hello, everyone, and welcome. Today, we're going to break down one of the most important tools in all of global trade, the letter of credit. We're going to zero in on the one rule that truly makes it all possible, the bank's absolute ironclad promise to pay, which is all laid out in Article 7 of the UCP 600. So let's just jump right in with the big question. Picture this. You're about to buy a huge amount of product from a supplier who's literally on the other side of the planet. How do you, as the buyer, make sure you don't just send your money into a black hole? And if you're the seller, how do you ship all those goods and know for sure that you're actually gonna get paid? This is the fundamental problem of trust that we're gonna solve today. And the solution? Well, it's this really clever tool called a letter of credit, or an LC for short. At its very heart, an LC isn't really about the goods. It's about the paperwork. It's a rock-solid promise from a bank, usually the buyer's bank, that basically steps into the middle of the deal. It promises to pay the seller, but there's a catch. Only if the seller hands over a very specific stack of documents that prove they did their part. Now, to really get this, we're going to build it from the ground up, kind of like a pyramid of trust. We'll start at the foundation, which is the bank's core promise. Then we'll see why banks are laser-focused on documents, not the actual products. After that, we'll cover how they check that paperwork, what happens when things don't line up, and finally, how the whole system holds together. All right, let's get to the absolute hearts of the letter of credit, the issuing bank's promise. This is what Article 7 of the Banking Rules, the UCP 600, is all about. And honestly, this is what gives the entire system its strength. So here's the key takeaway. Once a bank issues a letter of credit, its promise to pay is irrevocable. That's the magic word. It means it can't be taken back, it can't be changed, unless everybody agrees. The bank is completely locked in. It is legally bound to pay up as long as the seller presents the right documents. But what exactly triggers that payment? It's something called a complying presentation. It sounds technical, but it just means the seller submitted all the paperwork exactly as spelled out in the LC. Everything has to match perfectly. The terms of the credit, the official banking rules, and standard practices. It has to be a perfect match. This promise leads us to the single most important idea in the world of LCs. It's called the Autonomy Principle, and it's a bit of a mind-bender at first. It basically creates two separate worlds. The world of documents and the world of the actual stuff being shipped. The rulebook itself says it best. Banks deal with documents and not with goods. What does that actually mean? It means the bank, well, they just don't care about the physical shipment. They aren't experts in iPhones or t-shirts or frozen meat. They're experts in one thing: checking documents. Their decision to pay is based only on the paper in front of them, and it's totally separate from the sales contract between the buyer and seller. And this right here is the perfect example. Let's say you have a letter of credit for a shipment of frozen meat. The LC says the seller has to provide a veterinary certificate. So the seller hands one over, and on paper, it looks perfect. But what happens if the buyer opens the container and finds out the meat is spoiled, and the certificate itself even says the goods are unfit for human consumption? You might be surprised, but the bank must pay. Why? Because its promise was never about the quality of the meat. Its promise was tied to the presentation of a document called veterinary certificate. The paper was correct. Now the buyer has a big problem, for sure, but their problem is with the seller, not with the bank. This separation is exactly what makes the system so predictable for everyone. So, if banks only care about the documents, what is it they actually do? Well, that brings us to their main job in all of this, the duty to examine. This is where the bank puts on its referee. Banks have to examine documents on their face. Now, this isn't just a quick glance. It means they have to go through every piece of data on every single page and make sure it all lines up with the LC and with the other documents. But, and this is so important, they are not allowed to look behind the documents to see if the information is actually true in the real world. Here's a super simple way to think about what they might find. Let's say the letter of credit clearly calls for tubes, but the invoice from the seller describes the goods as pipes. Now, you and I might think that's close enough, but to a banker, pipes aren't necessarily tubes. This is a potential conflict, a discrepancy, and it's a perfectly valid reason for the bank to refuse payment. And that leads us right to the next logical question. What happens when the bank does find a discrepancy, like pipes instead of tubes? Well, they can't just say nope and walk away. There are very, very strict rules they have to follow if they want to refuse. First things first, the clock is ticking. From the day after they get the documents, the bank has a maximum of 5 banking days to check everything and make a call. They either have to pay or they have to refuse. That's it. This tight deadline means the seller isn't left hanging for weeks on it. Now, if the bank decides to refuse, it has to follow this exact playbook. They check the documents, they find a problem, and they decide to refuse, all within that 5-day window. Then, and this is really important, they have to send one single notice of refusal. And in that notice, they have to list every single discrepancy they found. They don't get a second chance to add more problems later. And they have to be incredibly specific. A bank can't just send a message saying something vague like, invoice not as per LC. That's not going to fly. They have to spell it out. For example, invoice describes goods as pipes, but the letter of credit describes goods as tubes. This protects the seller from lazy or unfair rejections. Okay, just one last piece to this puzzle. Let's quickly talk about how this promise extends to other banks that might be involved. You see, the seller often works with their own local bank, which we call a nominated bank. Well, the issuing bank's promise covers them too. Article 7 makes it crystal clear. If that nominated bank does its job, checks the documents, sees that they're perfect, and pays the seller, the issuing bank absolutely must pay them back. The promise is so strong that the issuing bank even takes the hit if those perfect documents get lost in the mail. That's how you keep the entire global chain of trust secure. So let's recap that pyramid of trust we just built. At the very bottom, you have the foundation, the bank's irrevocable promise to pay. Guiding that promise is the core principle. Banks only deal with documents, not with goods. That's all managed through a super strict examination process that has clear rules for refusal. And what's the result of all this? You get a predictable, reliable, and secure system that lets total strangers do billions of dollars of business all over the world. And that brings me to a final question for you. Now that you know the bank's entire role is secured by paperwork, not by the actual quality of the goods, how does that change the way you think about where the real risk is in an international deal? It's not just about getting paid. It's about getting the paperwork 100% right. Thanks for joining me for this explainer.